Hey everyone, back again for another edition of That's Our Two Satoshis Live. I am joined by my colleague Nick Coates. How are you, sir?
Hey Jeff, I'm doing well.
Is that an Arca sweatshirt you have on, by the way?
Oh yeah, it is.
Nice.
Oh wrong. Yeah, there we go.
Very nice. Well, I'm Jeff Dorman, Chief Investment Officer of Arca. As we do every week, we are going to discuss what's going on in the digital asset market. It should jive a little bit with the blog that we release every week as well. For those who are new to this, we write a blog called That's Our Two Satoshis on our website, ar.ca/blog. Before we get into the market, quick disclaimer, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. So I brought Nick on because we're going to talk a lot about Ethereum. So if you are interested in the roadmap of Ethereum, stay tuned. We'll get to that in a second. But first, I guess we got to talk about this rally that we're seeing in digital assets. Not entirely unexpected. I think, for those who listen to us or read us, we've been talking for a couple months now that it felt like we had somewhat bottomed in the market, although what we were lacking was any real catalyst to go higher. Still necessarily haven't seen those catalysts for going higher, but I think sometimes the catalyst is just that prices stop going down, and all of a sudden you have a little bit of short covering, and then you have some futures liquidations, and then all of a sudden it spurs a pretty big rally. And the macro picture isn't hurting as well. The fact that we've had rates, going down now for about 3 straight months, and the equity market playing nice as well. But I thought what was probably most interesting about the first, couple of weeks of the year here was twofold, right? One is almost everybody thinks of the second half of the year being just a disaster for crypto and blockchain and digital assets because you've had just such a string of bankruptcies, and then obviously culminating in the fraud of FTX. But if you actually look at the returns, it wasn't really the case. The Bloomberg Galaxy Crypto Index was only down 6% in the second half of the year, and that compares to the S&P being up 1.5%. And if you look at long duration treasuries, down 10%. So really kind of middle of the pack in terms of just overall performance of digital assets. And even though Bitcoin was down 16% in the second half of the year, you had plenty of others that were up. ETH was up 13% in the second half of the year, BNB up 13%, Matic 61%, Uniswap up 5%. So it was an interesting second half of the year because you had some disasters like Solana down 66%, and obviously tokens of bankrupt companies like FTT and VGX and Celsius all collapsing. But overall, the second half of the year was really not that bad. We just had this weird kind of valley around FTX. So Nick, we were talking about this on the desk, and I put a chart in the blog itself. But most of the rally of the last few weeks was really just the laggards playing catch up. For context, over the last 90 days, which puts you to middle of October, which was a few weeks before FTX imploded, over the last 90 days, Bitcoin's up about 10%, ETH is up about 20%. Most of the assets that rallied the most are still down 20 to 30% over that same time period, even though we saw year-to-date rallies now of 50 to 100% in names like Solana and Helium and Decentraland and Sandbox and Flow, Axie Infinity, you name it. Even Coinbase stock, right? Coinbase stock is up 50% on the year already. It's still down 25% going back to mid-October. So, I dubbed this the triple C rally, for those who are fixed income nerds like myself. Sometimes the triple C rated companies rally more than the double B rated companies just because they fell the most or had most to run. What do you make out of the rally so far being more, a recovery or catch up trade more so than anything fundamental?
Yeah, I mean, it certainly could have a bit to do with short covering. You would think that like the names that were down the most in the last 90 days probably were the most heavily shorted, and you just have some liquidations here being the reason for the buoyancy in these names. I mean, it also just speaks to some fundamental value here, right? Like if these names are being pushed down so much, and you do have other tokens that have performed relatively well in the second half, maybe it just kind of needed a little bit of change in market sentiment to have a revaluation here.
Yeah, I agree with that. Usually we're looking for fundamental reasons for improvement. There's been a few, right? I think fundamentally liquid staking providers, for example, like Lido have done pretty well. I think fundamentally, there's been a narrative shift of sort of the emergence of maybe new stable coins from your Curves or your Aves and your Fraxes. But for the most part, I guess you had Avalanche as well with their partnership with AWS. But for the most part, this really was broad-based, right? This wasn't really based on news or fundamental improvement. But then, of course, you get the reflexive nature, which is, well, once prices improve, everything starts to improve. Your TVL starts to improve, your transaction volumes improve. I think we were looking at week over week, volumes across DEXs and decentralized derivatives and even centralized exchanges being up in the 90 to 100% range. So obviously, it all kind of ties together. Maybe the tail wagging the dog a little bit, but ultimately, whether it started with fundamental improvements or just ended with fundamental improvements, you do see a little more of a healthy space right now than we saw a few weeks ago, for sure.
Yeah, I mean, not to push the envelope a little bit too much with like Ethereum, but I mean, right now the yield is something like 7.5%, just as a result of a ton more organic activity on things like OpenSea, on Uniswap, on all of the normal kind of DeFi and applications that we know and love from Ethereum that really hadn't gotten a lot of traction in many months are now starting to generate real fees and paying Ethereum validators.
Yeah, and I think I saw Ethereum basically went net deflationary again as a result of the increase in transactions, which is really the big story, I think, of 2022 is going to be, Bitcoin is effectively increasing its supply by almost $1 billion a month, or organically through just minor distributions, but also with regard to some overhangs like Mt. Gox and some of the other bankruptcies that are going to be distributing Bitcoin. Whereas ETH is potentially net deflationary and no new supply. So it'll be interesting to see how that plays out, and also how that increased activity in Ethereum affects some of the other apps and side chains that are built on that. So that's a pretty good segue, Nick, to what you wrote about. And for those who don't know Nick, every couple of weeks or months, he writes something pretty deep and pretty interesting. He's written a lot, over the years now for ARCA, and this is a really good one. Again, up on the website at ar.ca/blog. But your basic thesis here is that we need to kind of change the way people think about Ethereum from the world computer to the trust machine. So why don't I turn it over to you? Like, what exactly, as always, I'm always curious, what made you write this? What made you think of this? And where do we go from here in terms of Ethereum's roadmap?
Yeah, so really the catalyst for writing this for me was just kind of seeing the, I think, misunderstanding that people both outside and inside the industry have about what the kind of vision for Ethereum is. And I don't blame them, because for a very long time, there was a prevailing roadmap that was kind of the consensus for where Ethereum was going to go. And that's changed a lot in the last just 2 years. A lot of people even describe the merge as ETH2 or Ethereum 2, and that really hasn't been the terminology that developers have been using. So I really wanted to set out and kind of rewrite the story on what the new vision for Ethereum is, and kind of explain to people how the people at the forefront of developing the chain are kind of thinking about it going forward.
Okay, so dive into that a little bit more. So what is that? What is the new roadmap, and how do you think we should be thinking about Ethereum?
Yeah, so the big components previously of the old Ethereum 2 roadmap were about proof of stake, which was what happened with the merge back in September. So that is the only element that actually has gone into effect. The other one was shard chains, which are essentially they're separate chains, basically copies of the Ethereum blockchain, and that was meant for scalability. This was the big solution that would make Ethereum fast and cheap, and you'd essentially have all of the validators on Ethereum validating all of the different shard chains. And then the last one was that Ethereum was going to be a code base that was accessible to anybody. So you can use any coding language, not just Solidity or Viper or one of those, but you would really have, it would really be this world computer was the idea. And a lot of those have, there's been a lot of changes in the last couple of years as a result of both new technological innovations and just kind of seeing what the state of Ethereum has kind of developed over the last few years. So the big component that I think a lot of people recognize more and more is this idea that Ethereum itself is not going to be where people conduct transactions, or at least not in the vast majority of the transactions. What we're really moving towards is layer 2 rollups for doing that execution component of what Ethereum conducts. So Ethereum itself will be this layer where you're settling a lot of transactions from rollups to it, but you're going to be able to still get fast and fast and cheap transactions on the rollups instead.
So this is another fancy way of just basically saying that the holy grail of a blockchain to offer all three, right? The trifecta of speed, security, and decentralization is basically unsolvable. And as a result, we're going to have to split that up into different pillars, with Ethereum effectively being the security layer. Is that a fair assessment?
That is, yeah. And I think, it's what the kind of current consensus is that it's unsolvable when you try to put all of those functions together into one chain. But when you split them up into multiple chains, you can get the best of all worlds. And that's kind of what you're getting by separating out the rollups from the core Ethereum blockchain. You have the decentralization and the security of Ethereum, and the speed and cheapness of the rollups.
Okay, so what does this mean if you are thinking about building an app in terms of using Ethereum or some other blockchain? And what does this mean for investors, in your opinion?
Yeah, so if you're building an app, you're going to most likely be deploying on Rollups going forward, probably in addition to Ethereum for the foreseeable future. But you see more and more that apps are starting to launch just natively on Rollups, on a lot of these coming out this year, and even the ones that are already live, like Arbitrum and Optimism. That's going to, for a user, make fees a lot cheaper overall. Even now, fees are in the cents on these optimistic rollups, and there's a incoming upgrade that'll be in the second half of the year that will make those fees probably go down another 20x. So essentially, the cost to users is going to be very negligible of using these rollups. Whereas if you get some more demand, say we have another bull market, the cost of using Ethereum will go back up to $20, $30 and start to price users out.
Okay. So given that from an investing standpoint, I think we've learned over the years that if you don't create some sort of revenue or fee generation, your token is not going to be all that worthwhile, unless you have some sort of a narrative like Bitcoin, where it's 100% based on faith and future possibilities. What does that mean, though? If all fees get lowered, what does that mean in terms of the value of a token? Is it simply a supply-demand equation, which is if fees go down, you need to multiply the amount of users to get to the same level of revenue? Or is it going to be that there ultimately is just less value inherent in the layer one and layer twos as investments?
Yeah, there's a couple of cross currents at play here. I would say, the consequence of this upgrade that's coming up is that Ethereum itself is subsidizing the rollups. So it's really not that that the fees are going down in total. It's just that Ethereum is kind of reducing the fees that the rollups need to pay for security. So that's really making the rollups more profitable. But the overall vision for how these rollups are going to accrue value is, I think, still evolving. But the general consensus is that fees that the users kind of pay directly for using the chain are probably not going to be the big way they accrue value. What most of them are looking for is this concept called MEV, which is essentially like arbitrage transactions within DeFi. So if you imagine that the USDC is trading at 1.01 on Uniswap and 99 cents on Curve, there's an arbitrage there. And to get included and to be able to execute that arbitrage, you kind of have to beat all of the other people who also see that arbitrage. And that fees, those kind of incentives that you pay to access that arbitrage, flow to the validators of whatever chain you're using. And so that's how the layer twos are kind of seeing the ability to extract that as the kind of revenue model for their tokens.
Okay, so from a builder standpoint, you're going to be building on Ethereum and the various side chains. From an investor standpoint, there's still value, in your opinion, to both Ethereum as a security layer as well as to these layer twos, in terms of accruing value through MEV. What about from a user standpoint? You mentioned fees are going to go way down. What is an average, user who maybe has a MetaMask wallet, maybe has transacted here and there on a Uniswap or some other app? How are they changing their behavior as a result of this, if at all?
Yeah, I think one of the themes of whenever the next bull market occurs is going to be the migration of individual users away from Ethereum to these rollups, because when these rollups start competing for using Ethereum with individual users, it's really not a fair competition. So these rollups are essentially bundling up hundreds or thousands of transactions and sending them back to Ethereum. So if they need to pay a fee, they're able to pay a much higher fee than any individual user can justify. So I think as a result, the overall gas fees that you're paying on Ethereum to use the blockchain are going to go way, way up, and they're going to price out individual users. So I think, 5 years from now, anybody who is just an individual operating on their own will probably not be using Ethereum. That's going to be reserved for other blockchains and big institutions primarily.
Got it.
But I mean, really, also you're going to see, a lot of innovation, I think, that can come from the speed and the cheapness that these rollups are going to be able to give applications. A lot of things like social media, like gaming, that's just not available on Ethereum today. You just can't build an app like that given the fees and the slowness of the chain. So those rollups really open up an entire opportunity set that isn't available in the Ethereum ecosystem right now.
Yeah, for sure. Okay, well, as a parting thought here, and again, I'd encourage everybody to go read what Nick wrote here on Ethereum because it's very well laid out. But as a parting thought here, Ethereum becomes the trust machine. What are some major, if anything, like what will be the major takeaway you'd want people listening to this to come away with and thinking about Ethereum's future here?
Yeah, just that separating out these chains is kind of the future of how these blockchains are going to be architected. Ethereum is the settlement layer. That's where if you have a transaction, it will eventually be recognized on Ethereum, and Ethereum will broadcast that as the kind of recognition of finality. But transactions themselves are not going to be happening there for individual users. It's really going to be a story of rollups layer 2s being the execution function, and it's going to be beneficial for users at the end of the day.
Terrific. Well, for those who want to talk about Ethereum or other layer 1s and layer 2s, I'd encourage you to reach out to Nick. He can be found on Twitter at Nick_Hotz. And otherwise, we'll see where the rest of the month goes here after a pretty strong start. We'll see where the rest of the year goes. But I think all eyes are certainly on when this next bull market comes and whether or not these different layer 1s and layer 2s can handle the increased volumes and ultimately solve scalability. So, we're seeing it. We're seeing Web 2 partnerships. We're seeing corporations come over to blockchain and porting over their entire user bases from your Starbucks to your Nikes to your Reddits. So it'll be interesting to see this evolution of the blockchains and how they handle that scale. So again, I encourage you guys, reach out to Nick if you want to talk, if you want to nerd it up on the value of these blockchains. Otherwise, we'll be back again next week to talk about markets on That's Our Two Satoshis Live. Thanks, everybody.
Thanks, Jeff.